Alrighty, so this is the 19th video of the Maybe series and the 13th under valuations. And in this video, we're going to be talking about when do we use levered free cash flow in a DCF and what valuation does that actually give us, right? So in order to understand this, I hope that you guys remember from our unlevered free cash flow video and our levered free cash flow video what the formulas were for each one of these, right? So we know that unlevered free cash flow is EBIT times 1 minus the tax rate plus depreciation and amortization minus CapEx minus our changes in net working capital, right? And we know that levered free cash flow was essentially earnings before taxes, or times 1 minus the tax rate, right? Otherwise, we can call this net income, right? Plus depreciation amortization minus CapEx minus the changes in net working capital, right? So the real difference is in unlevered free cash flow, we use EBIT times 1 minus the tax rate. In levered free cash flow, we use net income, or EBT, pre-tax income, times 1 minus the tax rate, right? That's really the only difference here. But what does that actually mean, right? Well, that means that in unlevered free cash flow, we are looking at the cash flow that's available to all company holders, right? So this is relevant to our debt, this is relevant to our equity, right? So that means that all company holders, right? Because we didn't take into account interest here because it's earnings before interest. However, our levered free cash flow is the free cash flows that are available to the equity holders only, right? So let's think about it kind of intuitively, right? Well, if we're looking at cash flows that are relevant to all the company holders, and we're running a DCF on it, we're valuing a company based on the cash flows that are available to all of the company holders, then it makes sense that we would get a valuation that is also relevant to all of our company holders. That's why unlevered free cash flow pairs with enterprise value, right? Because the cash flows are relevant to all the company holders, right? So we're going to get a valuation that is relevant that is relevant to all of the company holders, right? Now, levered free cash flow is only relevant to our equity holders. That means if we run a DCF with levered free cash flow, this is only going to give us the equity value of that company, right? So that's essentially the thought process, right? If we took the cash flows that are available to our equity holders only, well, that doesn't take into account our debt holders, right? So that's not going to give us a value that is relevant to those debt holders. So if we run a DCF with levered free cash flow, this will give us our equity value, right? And if we run a DCF for our unlevered free cash flow, then it will give us a valuation that is our enterprise value, right? And in general, this isn't incredibly important, but if you're recruiting for FIG, this is a pretty common question to get, right? Because in FIG, they do not use unlevered free cash flow. They don't look at enterprise values because essentially those businesses are in the business of debt, right? So that's kind of their normal operation. So it doesn't make sense that you would look at enterprise value there. So you look at equity value. So that's why, especially for FIG, you should know that if we run a DCF with levered free cash flow, that will give us equity value. So I hope that's been helpful. And yeah, we'll hop into the next one.